What if I told you that mortgage interest rates just hit their lowest level in months? But that doesn't necessarily mean that they're going to stay there. Should you rush in to lock in a rate now, or is there a chance that we'll see even bigger drops ahead? And what happens if they suddenly spike back up? Well, hey, I'm Mike Petras with MPRE Boise, powered by Next Home Treasure Valley. And every week I break down exactly what is happening with mortgage interest rates, not just in the headlines, but the actual trends that actually impact home buyers, sellers, and investors right here in Boise, Idaho, covering areas like Meridian, Eagle, Nampa, Caldwell, Kuna, Middleton, and Emmett. But before we dive in, make sure to hit that like button, hit the subscribe button, and hit the notification bell so that you never miss out on one of these videos. And also share this video with anyone keeping their eye on mortgage interest rates. The markets move fast, and you do not want to miss these updates. Well, this week, mortgage rates took a strong, wild ride. We started off strong, rates hit their lowest level since December 9th, but by midweek, the market flipped and rates bounced right back up. So what happened? Let's break it all down. At the start of the week, the average 30-year fixed mortgage rate was sitting around 6.74% for top-tier borrowers. That's a big drop from where we were just a few weeks ago when rates were still over 7%. But by Friday afternoon, after a roller coaster of economic data and market reactions, many lenders had adjusted their rates back towards the upper 6 range, with some even creeping closer to 6.9%. So while we're still in a better position than earlier this year, this week was a reminder that mortgage rates can shift fast, and those waiting for the perfect moment might end up paying more. To understand why mortgage rates move, you have to understand that rates are directly tied to the bond market, specifically the 10-year Treasury yield. When investors feel uncertain about the economy, they tend to buy bonds, which pushes yields lower and mortgage rates down. But when economic reports come in stronger than expected, investors pull their money out of bonds and put it back into stocks, which pushes yields up and causes mortgage interest rates to rise. This week, 3 big reports hit the market and shook things up. The first was the ISM Manufacturing Index, which happened on Monday. This report tells us how strong the manufacturing sector is in the U.S. This headline number looked normal on the surface, but when you dug deeper, the details were ugly. New orders and employment fell hard, which is usually bad news for the economy. When investors saw this, they bought bonds and mortgage rates improved. The jobless claims on Thursday tells us how many people are filing for unemployment benefits. The lower the number, the stronger the job market. And this week, fewer people than expected applied for unemployment, which means that the labor market is still tight. Investors saw this and thought, well, if jobs are strong, inflation could stay high, and the Fed may not cut rates soon. That made them sell their bonds, which pushed up mortgage interest rates. And then, of course, today on Friday, the jobs report came out, the biggest report of the week. Early Friday morning, rates were looking good. Weaker job numbers means lower rates. But then as the day went on, the stock surged, bonds weakened, and rates climbed back up. But why? Well, the report was open to interpretation. On one hand, job growth slowed, which was good for rates. But on the other hand, wages kept rising, and that could keep inflation higher. But by the afternoon, lenders adjusted rates back up to where they were earlier in this week. So what does all this mean for you? Well, if you're watching rates early this week, you probably thought, this is it. Rates are finally going to come down. And you wouldn't have been wrong. But the markets didn't move in a straight line. Rates can drop fast, but they can also snap back up just as quickly, which is exactly what we saw this week. So if you're trying to decide whether to lock in on a mortgage rate now or wait, here's what is coming up next week that could shake up things even more. This upcoming week, 4 big economic reports could make or break the mortgage rate trend. On Tuesday, the NFIB Optimism Index and job openings, which is small business confidence and hiring trends, is coming out. If businesses are optimistic and hiring remains strong, rates could tick higher. If businesses pull back, it could help mortgage interest rates. On Wednesday, the CPI inflation report comes out. Now, this is the big one. If inflation comes in higher than expected, rates will jump. If inflation is cooling, expect the rates to drop. On Thursday, the producer price index and jobless claims come out. This measures inflation at the wholesale level, meaning if businesses are paying more for goods, that cost gets passed on to the consumers and rates could rise. And then, of course, lastly, on Friday, the consumer sentiment report. This tells us how confident Americans are in the economy. If people feel good, they'll spend more, which can push inflation up. If confidence drops, rates could ease. So all eyes will actually be on deck for Wednesday's CPI report because that's what the Fed is watching the closest. If inflation is still running hot, they won't be in a hurry to cut the federal funds rate. And that means mortgage rates could stay higher for longer. So given all of this, what's the move? Well, here's my advice. Pay attention to Wednesday's inflation report. That is going to be the biggest driver of where rates go next. And if inflation is hotter than expected, expect mortgage interest rates to bounce back up. If it cools off, we could see another push lower. So make sure to hit that like button, subscribe, hit the notification bell, and share this video with anyone who is buying, selling, or investing in real estate. The more you know, the better the decisions you can make in this fast-moving market. Also, drop a comment below. Do you think mortgage interest rates will keep falling, or are we about to see them climb again? Let me know in your thoughts. But definitely hang tight for next week. We have a lot of important economic data coming through that's going to show how inflation is reacting and how the Fed is going to react to that, plus some employment and consumer confident numbers. Well, thanks again for watching. And of course, if you are looking for a strong lender that serves these states below that you can find in the description, then feel free to reach out to me. And while I'm not a lender, I do, again, have very, very awesome lenders that I can go ahead and put you in touch with in order for you to succeed in these markets. So thanks again for watching. I look forward to the day that we speak. God bless. And I look forward to the day that I call you my neighbor.